All right. Hello, everyone. My name is Corey Dayharsh. I'm here with Advanta IRA, and we are here with another educational webinar. Today's topic is evaluating private real estate sponsors before you invest with a self-directed IRA. And I have a guest speaker today. We have Catherine Herron from BAM Capital. She is the Vice President of Investor Relations over at BAM Capital. I've been working with Catherine and her team for a number of years. I know she has a wealth of knowledge she's here to share with you. Catherine, thank you so much for joining me today.
Of course. Thanks, Corey. Happy to be here and excited to dig into this topic.
Awesome. So for our audience, all of our contact information is here on the screen. I'm just going to leave that up for a minute. I'll also have it up at the end of the presentation as well, so you can reach out to either of us accordingly. If you have any questions about self-directed IRA, rules, regulations, strategies, and you're not an active client of ours, you can reach out to me directly. If you are an active client, please reach out to your client account manager, or if you're not 100% sure who that is, you can reach out and I can point you in the right direction. If you have questions about BAM Capital, learning more about what type of investments they have and some of the things that Catherine's going to talk about today, you can reach out to her directly as well. I've got her phone number and email address there. I can tell you from years of experience, she's very responsive, very happy to help, and as well as her whole team over there at BAM Capital. So a brief disclaimer just from Advanta's side of things, and I'm sure Catherine will either have her own disclaimer or echo these sentiments. We're here for educational purposes today. So I am not here qualified to provide you any tax, legal, or financial advice. I'm here just to provide educational content and facilitate Catherine providing educational content from her side of things as well. If you do need a tax advisor, legal advisor, or financial advisor, please consult those individuals appropriately at your own discretion and due diligence. We do have a resources page on our website where we've got people that have worked with us in the past or know the self-directed space. So you can find that on our website if you're looking for specific CPAs, attorneys that are familiar with self-directed investing. But that's our disclaimer, making sure you fully understand this is strictly educational content. So with that being said, I'm going to go ahead and turn it over to Catherine, and she's going to cover from her side, again, from BAM Capital, a real estate company, how to evaluate your private real estate sponsors before you make an investment. Catherine, the floor is yours.
Thanks so much, Corey. Well, thanks everybody for joining today. Again, I'm Catherine Herron. I am Vice President of Investor Relations here at BAM Capital, and I've spent pretty much my entire career in real estate and in the private equity space. And here at BAM, I focus on communication, education, and really growing and nurturing our family of investors that we have here. And over my career, I've worked with thousands of investors investing with SDIRA accounts and a number of custodians as well, which is why I'm excited to be here with Advanta, because they really are among the best custodians out there in general, but specifically also for investing in alternative investments with an SDIRA account, in my experience. So excited to share some knowledge today, and I hope that it is helpful. So with that, let's go ahead and get started. Really what today is about is diving into, right, if you made the decision to make some type of alternative investment with your SDIRA account, that can kind of feel like a little bit of a daunting starting place. How do you even go about starting to assess the investments themselves, what your strategy is? And an important component of that is understanding the sponsor, right? Because self-directed IRA investments, a lot of the time, not always, but most of the time, are typically the alternative investments, they're passive in nature, right? And so you really want to understand the sponsor because they are going to be the ones responsible for managing the investment while you are an investor. So in private real estate, right, the sponsor is the one that's driving the outcomes. Typically, the investments are long-term and illiquid. The results come over time, and a deal on paper, the results can really vary based on the quality of the sponsor. And so understanding the sponsor is really one of the most important considerations when you are deciding to invest, because the sponsor is the one responsible for devising the strategy, executing on the investment strategy, managing risk and decisions throughout the investment, and having a plan and knowing what to do if conditions change. And so again, passive investments, it's really important that you know who the sponsor is. And so today we're really going to cover 5 key things to look for and to make sure you understand when evaluating the sponsor.
And Catherine, as I advance to the next slide, let's just break down the term sponsor a little bit further for the audience, because some people may not be familiar with the term sponsor. And you and I know sponsor could mean general partner, capital raiser, syndicator, a lot of these different synonyms that pretty much mean the same thing. Can you kind of explain what the maybe nuance there is with those different titles?
Yeah, I mean, they all do basically mean the same thing in the context of alternative investments in the real estate space. The sponsor is really the responsible party for throughout the life of the investment. And so the sponsor is going to be the one purchasing the underlying real estate. They are going to be the ones offering the investment to investors for participation. They are going to be the ones responsible for managing and overseeing the execution of the business plan, right? To get and achieve those targeted returns. They will be the ones deciding on the exit plan. They're really the manager, capital M manager in all senses of the word.
And that's perfect. Someone actually used the Q&A box to put in operator and manager, just to add to what we were talking about. So that's a quick reminder as well for the rest of the audience. We do want your active participation. So please use the Q&A box as you post questions in there. I'll be interjecting to Catherine, asking these questions as long as they relate to what she's talking about in the moment. Other questions, maybe miscellaneous items you have, still ask them. We've got a Q&A session that I'll facilitate at the end once the presentation is completed. Catherine, turning it back over to you.
Sure. So I did want to call out that there are some of the things that we're going to talk about today are going to be true regardless of whether or not you're investing with a self-directed IRA. But there is an important self-directed IRA lens or filter, as it says here, that I think is really important to keep in mind. It's really important that you partner with a sponsor, GP, manager, syndicator, whatever word is used in that context. It's really important that you are aware and have asked questions and are comfortable that they, the sponsor, regularly support SDIRA investments, right? They should have pretty considerable experience there, because there is, there's operational things that have to happen in order for an SDIRA account to be eligible to invest in a specific offering. The operations teams need to know all of the reporting requirements that a self-directed IRA are going to require. And so you really want some level of assurity that the sponsor has worked with SDIRAs before, right? We talked about processes, documentation, and timelines. Having that assurance that they do work with SDIRA accounts and custodians on a regular basis generally is going to mean you aren't going to have to be following up to make sure any given piece of paperwork is filed on time or something like that. Just make sure that all the parties involved have worked with each other before and they're familiar with the SDIRA structure, because an investment can be really strong purely from an investment standpoint, might not be the best fit for an SDIRA account if you get the feeling that investing with an SDIRA account is an unknown thing for the sponsor.
And someone just posed a question somewhat related. What happens when sponsor behavior, intent, and risk-taking significantly changes after the initial evaluation of the sponsor?
Well, what happens if sponsor behavior, intent, risk-taking significantly change after the initial evaluation of the sponsor? I think the essence of that question is, what do we do if the investor maybe no longer wants to be part of the investment? They feel like that the nature of the investment may have changed. And I have a couple points to that. The first one is, anytime you enter an investment, you want to understand what level of liquidity there is. Some investment vehicles, there is a liquidity feature. You can at some point say, hey, I would like to redeem my investment. Some products allow for that. Others don't. So just knowing which field you're playing in from the start, I think is really helpful. And I think the other thing too is, sponsors do have all of the control when managing the investment. And sometimes, depending on market conditions or just things that are going on, they need to be able to enact on that flexibility that they have to potentially update the strategy or make decisions that really are in the best interest of the investment, even if it's not originally how it was intended. Sponsors have to be adaptive to the market as well. And so I think that is mostly my answer to that question.
Yeah, no, I agree with you. I think the main thing from my side, answering a question like that is it's very important and critical with self-directed investing because you don't have a fiduciary looking over and kind of signing off on your investments to really build that know, like, and trust that we hear all the time. And in this case scenario, with respect to that question, trust being the key factor. Make sure you trust them, that you don't think that they're going to just completely switch their strategy and their talks. And if they do switch that strategy, that you trust, as Catherine said, that they're doing it because of market conditions or it's the best pivot point for the investment in itself in the long run.
Mm-hmm.
And Catherine, there, I just advanced the slide for your next portion.
Sure. So when you're out evaluating sponsors, really just in general, best practice is to have a consistent structure, right? Have a consistent framework so that when you are evaluating the sponsors, you're looking at the same things. You're asking the same questions so that you have an apples to apples comparison. You should go into it really knowing the things that you want to know and find out so you can get your research. It can be very easy to be swayed by, not swayed, but be, really heavily influenced by marketing decks, which absolutely have a time and place, but just make sure you're looking at the same dimension across all of your sponsors. Then that's just full visibility for yourself. And so evaluating a sponsor takes place through a number of mediums, right? Reviewing the offering materials. We just talked about like the marketing deck. So there's offering materials. There are the underlying legal documents for any investment. There's the sponsor's website where you can, I'm sure, find links to webinars, any information that they publish on themselves or on their offering. Talking to the sponsor's team, right? That's very, very important. I don't think any investors these days are making an investment without actually speaking with someone at the sponsor. And then continuing the conversation, right? Asking follow-up questions. And again, making sure you understand the investment. You've run yourself through the framework before you commit capital.
And Catherine, let's talk real quickly about the sponsorship documents. So, the names I hear, PPM, private placement memorandum, or prospectus. Like, what is an investor that maybe has never done this type of investing going to receive? Like a packet of 10 pages, 15, sometimes, I've seen 120 page, initial sponsor documents for an investment. Can you give a ballpark of what someone can expect if they've never done this strategy before?
Yeah. So, you're pretty much always going to have offering materials like an investment summary and investment thesis deck. And that really goes into what is the investment thesis, right? What are the targeted returns? Who's eligible? How are they going to go about executing on the investment thesis? What is the sponsor's track record? Really, it gets a high level look at all of the things that you need to know before investing. And I think it's important to look at the offering materials a lot of times as a starting off point, right? That's the basis that you need. And then you can ask questions from there, depending really on what your questions are. So you always have offering materials in that way. And then there's always also going to be what's called the private placement memorandum. That's the PPM. And that's really the governing document for a private investment. That's the legal doc. That's the thing that's, 50, 60, 100 pages long, but it really lays out everything. It details how the offering is structured, how the investment works, key risks, and the legal terms so that investors have the absolute full picture. So it's that PPM also satisfies securities disclosure requirements. It's not really used to market the investment, but it is the underlying governing document for any investment that is made.
Awesome. Thank you for breaking that down. And there we go. The next slide.
Okay. Well, I've talked about this a little bit, but how to use the framework. Again, best practice is to apply all of these 5 dimensions that we're going to go into with any sponsor that you're looking to invest with. Pay attention to how information is explained, not just what is shown, right? You could be shown information and have a lot of follow-up questions. How do you feel when you're getting those answers? I think that's an important component too. And again, you really want consistency really across the materials. If you get any offering materials that appear to have conflicting information, or targeted returns say one thing over here and then they say something different over there, that's something you need to be paying attention to. And so after you've done all of your evaluation, what does a clear or a sufficient evaluation look like? After you've done all of your due diligence, I think it's really important to understand, number one, I talked about this a little bit earlier, but can the sponsor support SDIRA account investments, right? Not just the product, right? Because the product has to be able to support the investment, but the actual sponsor itself, the operations team, are they going to not make your life harder because this is an SDIRA investment? Does the sponsor have experience with SDIRA accounts? That's really important. And the rest are really some of the dimensions we're going to get into, but do you have an understanding of how the sponsor is compensated, right? Are your incentives aligned with the sponsor and vice versa? Who makes key decisions? Again, this is a passive investment, but it's still important to at least know. And then what does the sponsor do when conditions are uncertain or when things have changed a little bit? That can happen over the course of a long-term illiquid investment, but how does that show up in reality?
There we go.
Thanks. And then just one quick note, education is really very important to us here at BAM for all of our existing investors, all of our future investors. And we have an actual formal built out education program on our website. When it comes to private real estate, when it comes to investing, sometimes it can feel a little bit like a foreign language. And really, we just want to demystify that in a way. And so we have an education platform called Pathways to Passive Wealth, where folks can register, review materials at their own pace, and really kind of pick their own adventure when it comes to learning about this. So I did just want to make the audience aware that resource does exist, should you want to dive deeper into any of this information. And with that, we can go ahead and dive into what exactly are the dimensions, what are the lenses we should be using to evaluate a private sponsor. And the first one is the track record. That's a really important one. What is the track record? The track record tells you, it's intended to tell you about past performance, right? It's all great to have an investment offering today. How have the prior investments that you've offered, how did those shake out? That's pretty important to know. Of course, we know that, past performance is no indication of future performance, but nonetheless, it's important context for you to have. So it's a really important input, but not all track records are created equal. They can be displayed and formatted in lots of different ways. And there's a couple of key things you want to really make sure you understand when looking at a track record. And I think one of the most important things you can know when looking at a track record is, does this track record show actual realized results, completed investments that are completely done, or does it also reflect some that are still in progress? You just need to know what you're looking at. There are some track records that do show investments still in progress, and that might make total sense in context, but just know what it is that you're looking at. I think another important thing too is having at least a baseline understanding of how the reports are calculated, how they're labeled. A lot of track records will have footnotes that explain like what some of the headers in the track record mean. Read those footnotes. I know it's easy to glaze over them, but they generally are there for a reason, and reading them will help you understand the document better, which is what the whole purpose in looking at it is. And then I think an important question to ask, because it's not always evident in track records. Track records are very number heavy by nature, but ask the sponsor, what was the market like when these investments were made? Right? Was it a buyer's market? Was it a seller's market? Was it a balanced market? What exactly was going on in the capital markets world, in the real estate world at the time these investments were made? I think that can be very telling as well. Ideally, you'll look at a track record that shows performance over a range of market conditions, the good and the bad. And balancing all that together will, I think, be really helpful in helping you understand what exactly you're looking at and meant to interpret from the track record. Things to keep in mind, right? Track record blind spots. It can be sometimes easy to overlook if a track record is only highlighting the best deals that a sponsor has done. You should be asking, if it doesn't say on the track record somewhere in the footnotes, is this the full track record, all of the investments that you've completed? Or are we being a little selective and only showing the best of the best, right? We talked a little bit about performance without market context. Again, that probably won't be explicitly written in a track record, but make sure you ask and understand what was going on in the market when these investments were made. And the assumption that recent success will continue. I think every investment document in the entire world says past performance is not an indicator of future performance. Nonetheless, just always have that in mind.
And Catherine, there was a question that came in from the audience relative to track records here. If I'm considering a real estate investment and I already know that the sponsor is legitimate, what types of information can I diligently research in order to feel confident about investing in the real estate investment?
A real estate investment, and the sponsor is legitimate, what types of information can you can diligently research in order to feel confident about investing in the real estate investment? The track record, again, is one of them. The sponsor is legitimate, which is a great starting point. I'm assuming that means that you may know some of the principles there. You may have been referred to them by somebody. But looking at how their prior investments have shaken out, I think is really important. I think another thing that you can do is, you can ask the sponsor for references, right? I think that's important too. Kind of that social proof element, speaking to investors who have been with the sponsor for a while, and they can just share their unvarnished experience, how it's been, what they like, maybe what they don't, but I think that's an important thing too. And let's see, what types of information? I think and we'll talk about this a little bit later, but I think it's important to understand what a best case, and worst case scenario look like for any given investment. When you're talking to the sponsor and they really are only able to describe what happens in ideal conditions, I would ask more. I would probe a little bit more, because the more you know about not just what happens if something goes right, but also what happens if the sponsor might need a little bit more flexibility and adaptability, I think that's important too.
Awesome. Thank you so much.
Course. So to wrap up track record, when you're looking at it, the format of track records can vary widely across sponsors. So at a minimum, just make sure you understand, what you're looking at is realized. Has it actually happened? Is this investment complete, or is it an estimate of future performance? If you have questions or it's unclear how the performance is presented or explained, we definitely want to be asking questions about that too. And again, the market conditions and what was going on in the real estate world when those gains or those investments were realized. Because as we all know, 2026 is a different market than it was in 2022 when rates were extraordinarily low, and there was just a lot more capital markets activity. Okay, sponsor incentives. I think this is one of the most overlooked aspects of sponsor due diligence. Okay, understanding how a sponsor is paid, how they essentially make their paycheck as well, is a really strong indicator of how they are going to be making decisions throughout the life of the investment, right? Understanding incentives gives insight into what the sponsor's priorities are. And what I mean by that is, you can go to the next one, Corey. How sponsors are paid. It's generally of a mixture. It's not just one thing, right? Typically, you will see ongoing management fees, right? The sponsor receives compensation throughout the life of the investment to manage the investment. There are also, oftentimes are fees when an asset is acquired or when it is sold. What I'll say about those fees is a well-aligned sponsor, they are going to have those fees, but how do they look at them? Are those fees profit centers for them, or are they more just cost of doing business, kind of keeping the lights on, right? What you want is a sponsor whose the majority of their compensation is tied to how the investment performs. The better an investment does, the better that is for investors and also for the sponsor. Both the investors and the sponsor are motivated and are incentivized by a very well-performing investment. I think that's really the key there. And again, how those components all interact is really important. So what are some questions you can ask to determine if there is alignment between the LPs or the investors and the sponsor? It's really important to know if the sponsor is investing alongside investors. Does the sponsor have skin in the game? Does the sponsor, is their capital at risk right alongside investors? I think that's a pretty important thing to know. Again, we talked about this, is a vast majority of these sponsors' compensation tied to long-term favorable outcomes. That's important as well. What fees are paid and when. And another important thing is, are the targeted returns that investors see in a lot of those offering materials on the websites, wherever it is, are those net of fees, right? Because you wouldn't want to be in an investment anticipating a 15% IRR, because that's what all the materials said. But it turns out after the fees and everything else, that nets out to a 12. You just need to know what you're looking at. So when you're looking at the sponsor and what their incentives are and really looking for that alignment, just make sure you understand how a sponsor is paid and when. If they are incentivized to have the investment perform to the maximum potential, really, has the sponsor invested alongside the LPs? Do they have skin in the game? And again, to those fees, are the targeted returns that you're seeing after contemplation of the fees. Another dimension is decision-making control. And this one can vary by offering, but again, with most of these investments being passive, the headline here kind of is that the decision-making control almost all the time lies with the sponsor. That's what they're there for. Passive investors typically don't want to have to, vote on certain aspects of an investment, vote on a business plan, vote on financing changes. Some structures will have that, but it's not particularly common. But it's still important to know how control is structured within the investment. And so, again, the sponsor is most likely going to have control over the initial debt terms, any refinancing that might happen. They typically are going to be the ones saying, all right, we've enacted the business plan, we've added the value. Now it's time to exit. Now it's time to sell the asset and, return proceeds and capital to investors. And importantly, again, we talked about this a little bit earlier, but these are long-term investments and the markets can change. There's always going to be some underlying volatility, which I think we can all attest to over the past few years. But it is the sponsor's responsibility to make adjustments when needed and be adaptable to whatever the current environment is. But that responsibility and that decision is with the sponsor. Yeah, and then this just understanding the structure. Again, it's important because, conflicts can arise even with aligned goals. If that happens, make sure we understand who ultimately has decision-making authority. When you're looking at the documents, more likely the PPM, the big legal document, that should clearly lay out what those decision rights are. And then just overall having that transparency that the sponsor is communicating when they might need to make a change. Those are all really important. And then, again, when it comes to decision making, these are passive investments, but it does still behoove you to know who at the firm has discretion over major decisions, how changes are approved and communicated, which we'll get to in a second, and what happens should stress befall the investment.
And Catherine, that brings up a good point regarding, stress on the investment or even positive possible outcomes with regards to like exit strategies, which you spoke about, I believe, 2 or 3 slides ago. So with these types of investments, just for the audience sake, they're usually roughly 3, 5, 7-year hold or so. And there's an exit strategy plan, but there's usually also provisions for market conditions, creating an opportunity for an early exit strategy or even holding the asset longer than initially planned. Can you just speak about that a little bit as it relates to decision-making power and how those decisions are ultimately made?
Absolutely. And I think this ties really nicely to the incentive line as well, right? If the sponsor that you're working with primarily receives the majority of their compensation when the asset sells, there really isn't an incentive for holding that asset kind of any longer than it needs to be held, right? A well-aligned structure means that a sponsor isn't going to be incentivized to just hold the asset for an indefinite amount of time, which kicks the investor's payday out a lot of times, but it also kicks the sponsor's payday out too. And so, yeah, I think that flexibility, though, is really important because, to your point, I can speak at least to BAM. There have been assets that we've purchased. Again, this was a while ago and market conditions were a little bit different. We were expecting a 5-year hold. Year 2.5 came around and the market was looking good. We had done what we needed to do. We accelerated the exit timeline. Flip side of that, I think we all know that 2024, 2023, those are really difficult years to sell. It was definitely a buyer's market, and there were investments that absolutely, we needed to continue to hold. Otherwise, we were giving away and eroding value. So that flexibility, I think, is really important, and having that confidence that the sponsor is pretty consistently having their eye on the ball in terms of knowing what's going on with the market when it's starting to butt up against the end of the estimated hold period.
Awesome. Thank you for elaborating on that.
Of course. All right. Communication and transparency. So I think that really the golden standard is with any sponsor at any point in time, can an investor, if someone asked, hey, how's your investment going? They can pretty clearly articulate that. They don't have to know necessarily all of the details, but they have a good impression of how the investment is performing and what is going on with it today, right? It says here, frequent updates are less useful than clear ones. Frequent doesn't always mean that it's substantial. It's really that clarity that matters. A lot of being a real estate sponsor is having a business plan, right? That's how we add the value to the assets, which ultimately is what gives value to investors. That strategy sometimes can change, but is there communication on that topic? What is happening with the investment and why?
And someone in the audience asked if you could define frequent. I mean, from my side, I've seen sponsors do monthly or quarterly conference calls or memos out to investors regarding an investment, but what would your definition of frequent be?
Well, I think what I meant here was, an update every 2 weeks that doesn't say much is probably less useful than a clear, well put together quarterly update. It's kind of a quality versus quantity triangulation there. I would say that at a minimum, sponsors should be communicating quarterly. I can speak at least for BAM, our investment periods are a little, they're typically around 5 to 7 years. And there are just periods during the stabilization phase and the hold period where it's business as usual. And that makes sense for a quarterly update. Conversely, if an asset is really in its exit phase and there are asset sales happening, a lot of activity, those are probably going to warrant, at a minimum, the quarterly, but then ad hoc updates as well.
Got it. Thank you.
So effective updates, what exactly do those look like? I think it's important that, again, and at any point in time, you really should have a pretty good sense of how your investment is performing. So performance updates on the investment, operations of the underlying investments, right? This is multifamily real estate. So how is the property doing, right? Anytime there is a change, anytime there's a headwind, a tailwind, are those clear or are they buried? And then, updates during both stronger and weaker periods. I think it's concerning if the cadence and the content of an investment that might not be performing so well, if that decreases, right, the quality and the quantity of investment of updates that you're getting, that's probably a problem. You just want to be clear, right, on what's going on with your investment. And so when you're evaluating a sponsor, to bring all this back together, these are questions you really want to ask. How often should I expect to hear from you on my investment? Do you have like a portal where I can go check on my investment updates there? If I miss the email with the update, is it in your portal as well? And if you're not an investor yet, ask for a sample of what their quarterly reporting looks like. Ask for just an example, right? Even if some of the information is redacted, but just ask for an actual communication artifact. I think that's something that that doesn't necessarily get asked. Like, I actually want to see it. And if the sponsor isn't willing to give you that, I think I would dig a little bit deeper into that. Again, when you're getting updates from a sponsor, it says here whether updates are substantial or substantive or promotional. Listen, the reality is that any sponsor out there is going to send promotional items to, their investors, to their future investors. But are you also getting information on how your investment is performing? What does their communication plan look like? Maybe when things need adjustment, right? When there's opportunity for some updates or changes. And, how consistent is their communication, right? As they're providing information on their investments, are they able to kind of tell the story of the investment? And does the story make sense? So when you're evaluating a sponsor, understand what to expect from updates. What's their philosophy on communicating challenges, changes, substantial updates? And then do they have a cadence? Is there a minimum expectation for when you should expect to hear from a sponsor? And then understanding what the downside could look like. I think almost every offering out there that has those offering materials, they're very clear on what the thesis is and what the expectations are for how the investment should play out. But do you have clarity on what it might look like if there's not only upside, but the potential for downside as well? And so making sure you have an understanding of that is pretty critical too. So sponsors, how are they thinking about downside? Which means how should you be thinking about downside when assessing an investment? The sponsor is going to say how they expect to achieve the targeted returns. Do those assumptions ring true, right? And I guess an example there would be if a sponsor, if their investment thesis, if the success of that thesis is predicated on 10% rent growth in a market where historically rent growth is at 2%, that's worth digging into, right? But you need to beat up that assumption a little bit to make sure you understand really where that's coming from. It may make sense in some contexts, but on its face, I think that would be worth investigating. I think that understanding the leverage speaks to how the property is financed. Is the sponsor overly conservative, under conservative, or really kind of striking the right balance? And then really it just comes down to having the feeling and asking the questions to make sure that the sponsor has a plan if something goes not to plan, and that they have the flexibility to, like we talked about a little bit earlier, Corey, abbreviate the hold period, extend the hold period if needed. And so it's really realism, right? Again, do any assumptions that you see in the offering materials, which there are a lot of assumptions in there, do they feel real? Because the reality is that, markets will shift, assumptions can change, and that flexibility does matter. And just getting a sense that the sponsor understands that, I think, can give you just a sense of assurance as the investment progresses. Again, I've talked about this a little bit, but what are the assumptions? Why are they there? Make sure you understand those. What happens if things need to change? And do you have a good understanding of the underlying leverage and liquidity of the investment? I'm going to go pretty quickly through this because I want to leave time for questions, but, common things that we see outside of the framework that we've talked about is really hanging everything that has to do with your decision on whether to invest or not, putting all of the weight on what the projected returns look like. That is a factor, and it's very important, but it shouldn't be the end all be all because there's always more to it than that. Choosing familiarity over fundamentals. I guess what I mean there is, you can have a sponsor that you're very familiar with, which is amazing. That cuts a lot of guesswork out. Still just make sure that the underlying investment of any new offering you might be considering is sound. And the marketing materials are great. They are a starting off point. Still make sure that you're asking the questions that you need. So we've gone through the 5 dimensions. We've gone through the framework. Again, best practice. Use it consistently across any sponsors or opportunities that you're evaluating. To the extent possible, try to ask structured questions. Ask the same question to all of the sponsors. And, make sure you understand kind of what the trade-offs are with any investment, right? Some investments will have liquidity, some won't. Okay, well, what's that trade-off for you? I think that's important to know as well. So private investments, especially with an SDIRA, I mean, those are long-term commitments. And so our desire, and the reason we wanted to get together and talk about this today, is simply just to make sure you understand the investment, you have done your due diligence in evaluating the sponsor, and that the investment decisions that you make with your retirement dollars are truly in your best interest, and you've done everything you can to ensure the best outcomes possible in an investment and in a market that does have a degree of uncertainty sometimes. And so we hope that you walk away with, a framework and a way to approach evaluating sponsors so that you can make the best decisions for you.
Awesome. All right. Well, thank you very much, Catherine. What I'm going to do now is just relate everything Catherine just talked to our audience about to making these types of investments with a self-directed account. And in order to do that, the first thing I really want to talk about is disqualified persons. So there's very simple rules regarding self-directed retirement investing. And the main one that applies when you're talking about real estate investing as a limited partner is understanding who you can and cannot invest with from a sponsorship side of things. So there's disqualified persons to your retirement account making an investment. And those are basically your lineal family tree: yourself, your spouse, your parents, your grandparents, your children, your grandchildren, and any businesses that those individuals own or control day-to-day operations of. You're not allowed to transact with them, meaning my retirement account can't invest into a real estate deal as a limited partner if my father is a sponsor, or if I'm a sponsor, or my spouse is a sponsor, or my child. So that's the main rule that a lot of people don't understand when they start thinking about retirement account investing, or maybe even have a family member that is a sponsor and they're like, oh, I love what Johnny's doing at his company. I want to invest some money with him. Well, technically you can't if Johnny's your son or your father, or again, anyone on that family tree. And furthermore, you may notice here on the slide that extended family members are not considered disqualified. So siblings, aunts, uncles, cousins, those are not considered disqualified. So if those types of family members are sponsors, you could invest your retirement dollars into those deals. And what it looks like to make one of these investments, again, I harken back to my initial slide on the disclaimer. This is just educational content. These are rounded numbers. They're reasonably accurate for what you could expect for these types of investments. But in general, everything's rounded. This is just a very simple case study to illustrate for you what this type of deal looks like. So I've got a woman named Rebecca and a gentleman named John. Rebecca has funds in her retirement account and is looking into real estate investing. John is a sponsor. So John and Rebecca meet. She does her due diligence. John provides her all of the private offering opportunity information, and she reviews it thoroughly, decides she does want to invest. So what she does need to do at that point is set up a self-direct account if she doesn't already have one, initiate a transfer, which is a non-taxable event, to get her money out of her fiduciary account over into the self-directed account, and basically approve all of the investment paperwork that will be facilitated through the administrator. In our case, Advanta, your client account manager, will help you through this process. And the process, again, is that all the paperwork is executed in the name of your retirement account, not your personal name. So Rebecca's social security number and individual name is not on the documents. It's all listed in the name of her retirement account. That goes to the Advanta account manager to make sure Rebecca reviews and approves everything. And then we execute the investment transaction. We send the chunk of money from Rebecca's retirement account over to John's team that is sponsoring the deal. And the typical type of outcome or returns expected for this type of deal, again, rounded numbers here, a $50,000 investment was made. There's 8% preferred distributions to all investors or subscribers paid annually. So that's $4,000 a year. And in the fifth year, the property goes what we call full cycle and is refinanced, sold to a different investor group, whatever it may be. And a lump sum payout of $65,000 is returned to Rebecca. So that project went exceptionally well. Above and beyond the 50 she made $20,000 in preferred, the 50 she invested. She made $20,000 in preferred distributions and $15,000 of additional profit at the end because the project went so well. Again, these are rounded numbers. I can't stress that enough. You can't expect something like this, but it's up to you to do your due diligence and speak with the syndicator or the sponsor and figure out what that deal entails. Is there more liquidity and less of an end number of, $65,000 on a $50,000 investment at the end? There's a lot of different factors. It's up to you to decide where your comfortability is and what your actual expected and anticipated outcomes may be. With that being said, just real quickly before we turn over and I start going through the rest of the questions, it's real easy to get a self-direct account started up. It takes about 15 minutes to complete an application. It takes about a week roughly to get your funds moved over from your current plan, and you can start investing. Roughly 7 to 10 days after you open an account, you can put your money into one of these types of deals or any self-directed investment for that matter. Here's my contact information as well as Catherine's. I'm going to leave this up on the screen while I go back through the other miscellaneous questions that we got throughout the presentation. We do have about 5 minutes before we typically wrap this up, so please feel free to add questions here as we're finishing up. Just give me a minute to scroll back through to the beginning and see where I left off with any unanswered questions. All right, Catherine, can you address the guidelines around whether an offering must stay under 25% of raise to be total compliant / safe under ERISA rules? Is there some flexibility if you are not accepting pension plans, which I'm assuming just means retirement accounts, because pension plans are typically with a fiduciary and can't make these types of investments?
Right. So referring to the ERISA plan asset rules, the 25% test, and that test looks at whether 25% more of a fund's equity is held by ERISA benefit plan investors. So most self-directed IRAs don't fall into that category. And to my knowledge, Corey, chime in if you disagree, but the self-directed IRAs are not subject to the same restrictions as ERISA plan benefit investors. Now, there may be limitations on whether or not the offering can accept ERISA benefit plan investors at all, but that is independent of a self-directed IRA.
Yeah, I would generally concur. Yes.
Great.
All right. The next question here, I think it's more of a statement than a question, but an offering memo, aka deck, that's clean, inclusive, and structured gets a sponsor off on the right foot. Of course, the performa / underwriting and legal documentation must also be solid. I think that came in early on when you were talking about that first portion, the first dimension.
Agreed. Completely.
All right. How much would you say is assessing a sponsor defined by data versus personal feeling?
Ooh, that's a great question. So sponsor assessment is both. It's data and judgment. They play different roles though. So data will help you narrow the feels. The judgment really comes in when you decide who you actually trust with your money. Right. And so data, what that's going to do is that's very good at disqualifying sponsors. It might not be the best might not be the most helpful in selecting the best one. Right. Data answers, do they have a track record? What does that say? Are the returns directionally consistent with the strategy? Are the fees within normal range? Is their leverage reasonable? Those are all really important things to know, but those aren't really gut check feelings. So when you're evaluating sponsors and multiple sponsors clear your data bar, whatever that looks like, the numbers stop being the differentiator, and it's that gut feeling. Do their explanations make sense under scrutiny? Are they transparent about any mistakes that they have made? Do you like the person that you're talking to and interacting with? Like that matters, right? Do you feel listened to? Do you feel like you're going to look forward to talking to these people throughout the life of your investment? So it's gut feelings. It's also pattern recognition.
Got it. All right. This question is actually for me. If a lineal relative is a sponsor that only has, say, a 10% stake, is this still a disqualified investment? So the rules around disqualified persons stipulate that you are not allowed to invest if the general partnership side of the deal or sponsor side of the deal, the disqualified person has day-to-day decision-making role and responsibility and or 50% or more controlling stake or ownership. So if they're at a 10% stake and they also do not have day-to-day decision-making role or responsibility, then that's roughly a gray area. You could make that investment. We would facilitate it, but we would also implore you heavily to seek further legal counsel and make sure that you've done your due diligence from a legal perspective, just in case you're ever audited in the future, that you have support to stand your case as to why and how you made that investment and believed within the rules that it was compliant. The next question here, does the IRA have to pay UBIT tax versus the self-directed 401k? And UBIT, just for those of you that aren't familiar, unrelated business income tax, that's a commonly used term. In this case scenario with this type of investing, it's more so looking at UDFI, or unrelated debt financed income, which is a tax levied on a portion of an investment you make that is leveraged. Catherine talked about leverage earlier in the presentation. And the answer is yes. An IRA account is subject to UDFI tax, whereas a solo 401k account, solo 401ks are not subject to UDFI tax. And Catherine and I spoke about this a few days ago as well. When you're talking to a sponsor, it's important, if you're going to invest with your retirement account, to possibly ask them what their understanding of retirement account investing is, as she mentioned, and also if they know and utilize structures and strategies to help mitigate or avoid UDFI tax. Catherine, do you want to speak about that from your side as well?
Yeah, I mean, for some products that have leverage, it will apply. If the investment doesn't have leverage, then it won't apply. But when it does apply, like Corey was saying, there are specific mechanisms and structures in place that can block that. But it's something you should know going into the investment. Does UBIT apply? And if so, are there mechanisms in place to block it? And sometimes the answer is no, and that doesn't mean, at least in my mind, it doesn't mean disqualification. It's just something to be aware of so that you're not a year after your investment and you're like, wait a second, what's going on here? So that's an awareness thing.
Perfect. And we'll wrap up with this last question here. This came in earlier, but I saw it and just was like, this is the perfect last question for the presentation. Any common red flags to look for when considering a sponsor?
Ooh, that is a good question. Here, the uncomfortable reality is that a lot of risk shows up after you wire. Like, I'm sorry, but it's true. There are just things that you're not going to know until you're an investor. But to that point, right, I think it's important that when you are talking about, here's what a red flag would be to me, is I'm asking questions to a sponsor. Let's say I were looking to make an investment and I'm asking about risk. I'm asking for realism. If I feel the risk that I'm bringing up is minimized, generalized, or there's some hand waving, that's a little bit of a red flag for me, right? Good sponsors are going to explain how things could break and what they would do about it. I think that when it comes to fees, it should be clear, right? If you need, a decoding document to understand what the fees here, that would be a red flag for me too, because confusion on that topic typically isn't going to get clearer the longer the investment goes on. And then I think that skin in the game is really important. Is the sponsor investing alongside of you? I think not having that, I would just have so many questions. Why? If you, oh man, I'm trying not to get on a soapbox, but if a sponsor is willing to offer an investment to, their investors and ask them to invest, but they themselves aren't willing to do that, what do they know that I don't? I think those are some red flags that come to mind.
Awesome. Well, we are right at the 1 hour mark. So all of the audience here, I appreciate your participation and your time spent. You will receive a recording of today's presentation, so you can watch this back at your own pace. Or for those of you that weren't able to attend with us live, anytime you register for one of our webinars, you'll always receive a recording of it. So check out what we've got coming up on our schedule and register for anything of interest to you, even if you can't attend it live. Catherine, thank you so much for your time and
Sure.
the information you brought to the table. I always love doing different work with you, and it's always a pleasure. So thank you so much for coming and joining our audience and giving them some good insight and tips on how to evaluate sponsors.
Likewise. Thanks so much, Corey. It was my pleasure, and looking forward to doing this again soon.
All right. Thank you so much. Everyone,
Thanks,
reach out to either of
everybody.
us if you have any questions or need anything further. We'll see you next time.
Thanks.